Friends, thank you for being here today. What if I told you that your Canadian savings account is paying the mortgage on an empty Chicago skyscraper? What if the very banks we trust as pillars of stability, the institutions we're told are the envy of the world, have quietly become the dumping ground for American bad debt? This isn't speculation, this is mathematical reality unfolding in real time. Let me give you a number: $1.1 billion. That's how much Bank of Montreal set aside in a single quarter, Q4 2025, just to cover loans they expect to go bad. Not loans to struggling Canadian families, not mortgages in Toronto or Vancouver. No, this is money burned to plug holes in American office towers that sit vacant, floors upon floors of empty cubicles in cities like Chicago, Los Angeles, San Francisco. And BMO isn't alone. Royal Bank injected billions into City National, its crown jewel American subsidiary, the so called Bank to the Stars. Why? Because that jewel had turned to lead, weighed down by commercial real estate bets that went catastrophically wrong. Here's the paradox that should terrify you: Canadian banks are legally required to be conservative, risk averse, boring. That's the story we've been sold. The big five banks, RBC, TD, BMO, Scotiabank, CIBC, they're supposed to be the stable foundation of our financial system, the adults in the room while American banks gamble. Yet somehow these same conservative institutions became the bag holders of last resort for the American office crisis. While Goldman Sachs and Wells Fargo aggressively dumped their toxic office loans in 2023 and 2024, taking their write downs and moving on, Canadian banks held on. They're still holding on. This is a structural fault line, friends, and the tremors are already being felt in every Canadian retirement account, every pension fund, every savings account tied to these institutions. Let me paint you a picture of what's really happening. BMO isn't just a Canadian bank anymore. It is the third largest commercial lender in Chicago. Read that again. A Canadian bank is one of the biggest financiers of Chicago's commercial real estate. When you drive through downtown Chicago and see those for lease signs on tower after tower, there's a very good chance that a Canadian pension fund or your bank account is paying that mortgage. The numbers tell a story of inevitability. Office vacancy rates in major American cities have stabilized at catastrophic levels. Chicago, 25%, Los Angeles, 28%, San Francisco, 30%. These aren't temporary dislocations. This is permanent demand destruction. The work from home revolution didn't end, it evolved. Companies realized they don't need the space, they're not coming back, and Canadian banks are trapped holding the bag. But to understand how we got here, how the most conservative banking system in the world walked into this trap with eyes wide open, we need to go back to the beginning. We need to understand the genesis of this disaster. The year was 2015. The Canadian domestic market had hit a wall. Everyone who could get a mortgage had one. Housing prices were already stratospheric. The big five looked at their balance sheets and realized there's no room left to grow at home, so they looked south. The American market gleamed with opportunity, or so it seemed. The U.S. economy was roaring. Office towers in Manhattan commanded premium rents. Silicon Valley was printing money, and Canadian banks, flush with capital and confidence, decided to expand. BMO bought into Chicago's commercial lending market aggressively. RBC acquired City National in Los Angeles for $5.4 billion, calling it their gateway to American wealth. TD pushed deep into the eastern seaboard. Scotiabank diversified into American commercial portfolios. They weren't just buying banks, they were buying exposure. Exposure to the very cities that were about to be hollowed out by technological and social transformation. They bought tickets to the Titanic after it hit the iceberg, thinking they were getting a discount. Here's what they missed. The American commercial real estate market was already fracturing. The cracks were visible for those willing to look. E-commerce was destroying retail. Co-working spaces were cannibalizing traditional office demand, and beneath it all, a generational shift was brewing. Millennials and Gen Z workers who valued flexibility over corner offices. Then came 2020. The pandemic was the accelerant, but the fuel was already there. Work from home went from perk to policy overnight, and it never went back. Not really. Companies discovered they could cut costs by 30, 40, 50% by shedding office space. Employees refused to return to 5-day weeks in the office. The social contract of the office tower, that gleaming symbol of corporate power, was broken, and Canadian banks were left holding hundreds of billions in loans tied to buildings nobody wanted. Now, here's the mechanism you need to understand, because this is where your money disappears. It's called provision for credit losses, PCL for short. Think of it like this. Imagine a bank makes $10 in profit, but because they lent money to someone who can't pay it back, in this case an empty office tower, they have to take $3 of that profit and put it in a break glass in case of emergency box. They can't pay it out to shareholders. They can't lend it to Canadians who need mortgages. It just sits there waiting to cover losses that everyone knows are coming. In 2025, BMO and Scotiabank are burning through billions in PCLs. Every quarter, another billion or two vanishes into this black hole. And this suppresses everything downstream. Stock prices stagnate. Dividends, those sacred payouts that retirees depend on, are under pressure. The payout ratios, the percentage of earnings paid out as dividends, are stretched to dangerous levels. Some banks are paying out 60-70% of earnings just to maintain the dividend. That's fragile, friends. That's a system with no margin for error. And here's the secret the banks don't want you to know. They're playing a game called extend and pretend. When a loan is about to default, when the office building owner can't make payments because the building is half empty, the bank doesn't foreclose. That would force them to recognize the loss immediately. Instead, they modify the loan. They extend the term. They lower the interest rate temporarily. They pretend everything is fine. Why go through this elaborate charade? The answer is survival. If they recognize all the losses at once, the stock crashes. Regulators start asking questions. Depositors get nervous. So they play for time, hoping that somehow, some way, interest rates will drop and workers will flood back into offices and the crisis will magically resolve itself. But here's the mathematical reality they're fighting. It won't. The trigger event that exposed all of this came in the Q4 2025 earnings cycle. BMO and Scotiabank reported their numbers. On the surface, they beat revenue expectations. The headlines were positive, but anyone who looked beneath the surface saw the rot. The credit loss numbers were undeniable. Billions set aside. Provisions stacking up quarter after quarter. The market realized this isn't a one-quarter problem. This is structural. And then the Canaries started dying. Canary number one, the language changed. Suddenly, in investor presentations and earnings calls, certain U.S. loans were being classified as non-core assets. Let me translate that corporate euphemism for you, friends. Non-core means toxic. It means we want to sell this, but nobody's buying. It's the financial equivalent of a real estate agent describing a house as having potential when the foundation is cracked and the roof is caving in. Banks don't randomly decide assets are non-core. They reclassify them when those assets become liabilities they can no longer hide. And in 2025, Canadian banks started using that language more and more. The portfolios they bought into with such confidence, those gleaming American commercial real estate loans, were now being quietly shepherded toward the exit. Except there is no exit. Because who's buying? American banks already took their medicine. They wrote down billions in 2023 and 2024. They recognized the losses, took the hit to their stock prices, and moved on. The market punished them briefly, then rewarded them for ripping off the bandage. But Canadian banks, they're still bleeding slowly, hoping you won't notice the blood in the water. Canary number two, the dividend strain. Now, Canadian bank dividends are sacred. They're what grandmothers build their retirement around. They're what pension funds depend on for stable income. The Big Five have spent decades building reputations as dividend aristocrats, companies that raise their dividends year after year, no matter what. And on the surface, they're still doing it. BMO raised its dividend. RBC raised its dividend. Scotiabank squeezed out a tiny increase. The headlines read, Canadian banks demonstrate resilience. But look at the payout ratios. Look at what percentage of their actual earnings they're paying out just to maintain that dividend. 60%, 70% in some cases. That's not resilience, friends. That's desperation. A healthy bank pays out 40, maybe 50% of earnings as dividends. That leaves room for reinvestment, for growth, for weathering storms. When you're paying out 70%, you have no cushion. One bad quarter, one major loan default, and suddenly that sacred dividend is in jeopardy, and the executives know it. You can hear it in their voices on earnings calls, the carefully chosen words, the emphasis on manageable and well-positioned. These are not the words of confidence. These are the words of people trying to convince themselves as much as investors. Canary number three, watch what the Americans did. This is the forensic evidence that proves the game is rigged against Canadian banks. U.S. banks, the ones who originated these loans, who knew these markets intimately, who had every incentive to hold on to performing assets, they dumped them aggressively. Starting in 2023, there was a fire sale. Wells Fargo wrote down billions in commercial real estate exposure. JP Morgan Chase tightened lending standards and shed risky CRE loans. Regional banks that had loaded up on office tower debt either failed outright, like Silicon Valley Bank, like Signature Bank, or were forced into mergers where the bad assets were quietly absorbed. The smart money got out. And who did they sell to? In many cases, directly or indirectly, Canadian institutions, Canadian banks, Canadian pension funds, Canadian insurance companies, all convinced they were getting a bargain buying American assets at a discount. They weren't buying a discount, they were buying someone else's trash. And now they're discovering that when you buy toxic assets, you become toxic. Here's the trap they're in now, and it's a trap with no good exit. If they sell these loans today, they have to recognize massive losses immediately. The market value of a commercial real estate loan on a half-empty office tower in San Francisco is maybe 50, 60 cents on the dollar. Selling means admitting they overpaid, that their American expansion was a disaster, that billions in shareholder value has evaporated. Stock prices would crater. Executives would lose their jobs. Regulators would investigate. So they hold. They extend and pretend. They modify loans. They kick the can down the road and hope something, anything, changes. Maybe the Federal Reserve cuts rates dramatically. Maybe commercial real estate rebounds. Maybe a miracle happens. But if they hold, they bleed. Every quarter, another billion in provisions. Every quarter, earnings suppressed. Every quarter, the dividend becomes harder to maintain, and the wall of maturity is coming. That's the term you need to understand, the wall of maturity. These loans don't last forever. Most commercial real estate loans are written for 5, 7, maybe 10 years, and then they mature. They have to be refinanced. The borrower has to get a new loan to pay off the old one. Well, friends, here's the problem. These loans were originated in 2015, 2016, 2017, 2018, when interest rates were near zero. The borrowers were paying 3, maybe 4% interest. Now those loans are maturing, and the refinancing rate isn't 3%, it's 7%, it's 8%. In some cases, it's 9%. Can an office building that's 30% vacant afford to refinance at double the interest rate? No. The math doesn't work. The building doesn't generate enough rental income to service that debt. So the borrower defaults, and the bank takes the keys to a building nobody wants. The wall of maturity hits hard in 2026. Hundreds of billions in commercial real estate loans come due, and Canadian banks are sitting on a disproportionate share of them. This isn't a possibility. This is a timetable. This is inevitability clicking closer one quarter at a time. And here's what makes this crisis particularly insidious. It's invisible to most Canadians. Your RBC account looks the same. Your BMO credit card works fine. The branches are open. The ATMs dispense cash. Everything appears normal. But beneath the surface, the foundation is crumbling. This is what I call the illusion of stability. The banks have every incentive to maintain appearances. They spend millions on advertising showing happy families, trusted advisors, strength and security. They sponsor hockey teams and community events. They project an image of unshakable Canadian solidity. Meanwhile, their balance sheets are bloated with American assets that are slowly rotting. They're burning billions in provisions. They're trapped in loans they can't sell and can't afford to hold. And the depositors, the everyday Canadians who trust these institutions with their savings, have no idea. You want to know the real kicker? The tragic irony of this entire situation? We used to worry about American economic imperialism, about the US taking over Canadian industries, Canadian resources, Canadian sovereignty. That was the narrative for decades. Protect Canada from American dominance. And then, in a strange twist of fate, Canadian banks decided to colonize America. We marched south with our capital, our confidence, our supposedly superior risk management. We bought into American markets at precisely the wrong moment. We became the landlords of American decline. We didn't get conquered by America. We conquered ourselves by trying to conquer America. We exported our capital to finance their empty towers, and now we're paying the price. This is financial colonialism in reverse, and it's draining Canadian wealth southward every single quarter. Now, I can hear some of you thinking, but these are big banks. They're diversified. They have consumer lending, mortgages, wealth management. Commercial real estate is just one part of the portfolio. And you're right, it is just one part. But here's what you need to understand about how banks work. It only takes one bad asset class to poison the whole institution. Remember 2008? US banks weren't just mortgage lenders. They had credit cards, commercial lending, investment banking, wealth management, all of it. But subprime mortgages were enough. That one asset class brought down Lehman Brothers, destroyed Bear Stearns, required trillion-dollar bailouts. One crack in the foundation can bring down the whole edifice. Canadian banks are better capitalized than American banks were in 2008. I'll grant you that. Our regulators are stricter. Our systems are more conservative. But that doesn't make them immune. It just means the crisis unfolds more slowly. Instead of a sudden collapse, we get a slow bleed. Instead of panic, we get erosion. And erosion can be just as destructive. It just takes longer for people to notice. The question you should be asking right now is, what does this mean for me? If you have an account at one of these banks, are your deposits safe? If you own bank stocks in your RRSP, should you be worried? If your pension fund is invested in the TSX 60, which is heavily weighted toward financials, what happens when the losses become undeniable? Let me be very clear about something, friends. Your deposits are safe in the technical sense. Canada has deposit insurance through CDIC, the Canada Deposit Insurance Corporation. Up to $100,000 per account category is guaranteed by the federal government. If a bank fails, you get your money back. That's the letter of the law. But here's what deposit insurance doesn't protect you from: the slow erosion of value, the quiet transfer of wealth, the imperceptible drain that happens when banks use your deposits to subsidize bad loans in foreign markets. Think about it this way: when BMO sets aside $1.1 billion in provisions for credit losses, where does that money come from? It comes from the spread, the difference between what they pay you on your savings account and what they charge on loans. That spread is supposed to generate profit. Profit that funds expansion, pays dividends to shareholders, and yes, provides returns to depositors through interest. But when billions are being diverted to cover American office tower losses, that's billions not going into the productive Canadian economy. That's capital that could be financing small businesses in Saskatchewan, mortgages in Nova Scotia, infrastructure projects in Ontario. Instead, it's evaporating into the void of empty Chicago skyscrapers. You're not losing your principal, but you're losing opportunity. You're losing the time value of money. And in an inflationary environment, that's the same thing as losing wealth. Now, let's talk about the stockholders, because this is where the pain becomes acute and measurable. If you own shares in Canadian banks, either directly or through mutual funds, ETFs, or pension plans, you are directly exposed to this crisis. And the numbers are starting to tell a very ugly story. Look at the stock performance of BMO and Scotiabank over the past 18 months. Relative to the broader market, they've underperformed dramatically. While the S&P 500 hit new highs, while tech stocks soared, Canadian bank stocks have been dead money. BMO is trading at levels we saw 2 years ago. Scotiabank has actually declined. Why? Because institutional investors, the big money, the smart money, they can read balance sheets. They see the provisions stacking up. They see the non-core asset classifications. They see the payout ratios stretching, and they're voting with their feet. They're rotating out of Canadian financials and into sectors with less risk exposure. But retail investors, the everyday Canadians who own these stocks in their TFSAs and RRSPs, they're still holding on, trusting that Canadian banks are safe havens. They're trusting the dividends will keep coming. They're trusting that the banks will somehow navigate through this. That trust might be misplaced. Here's the scenario that keeps bank executives awake at night, the nightmare they can't say out loud. What happens if interest rates stay higher for longer? What if the Federal Reserve, trying to fight persistent inflation, keeps rates at 5% for another 2 years? What if the commercial real estate market doesn't stabilize but continues to deteriorate? Then the wall of maturity becomes a wall of defaults. Loans that are currently being extended and pretended suddenly can't be extended anymore. Buildings get foreclosed. And here's the cruel reality of foreclosure in a declining market. The bank doesn't just lose the loan. They acquire an asset, the building itself, that's worth far less than the loan amount. Imagine BMO forecloses on a Chicago office tower. They lent $200 million against it back in 2017 when the building was fully leased and generating strong cash flow. Now it's 30% vacant. It needs capital improvements, and the market for office buildings has cratered. What's it worth? Maybe $100 million, maybe $80 million, maybe less. The bank just realized a $100 million loss, not on paper, not in provisions, an actual crystallized, no way to hide it loss. And if this happens across dozens of properties, across multiple cities, those losses compound into a crisis that can't be managed with accounting tricks. Now multiply that scenario across the Canadian banking sector. BMO, RBC, Scotiabank, they're all exposed to varying degrees. If one bank starts taking massive write-downs, the market will start pricing in the same risk for all of them. Stock prices fall, credit ratings get reviewed, the cost of borrowing goes up, and suddenly the entire financial system is under stress. This is what I call the convergence, friends. It's not one thing that breaks the system. It's three forces hitting simultaneously, each amplifying the others. Force number one, work from home permanence. This is demand destruction on a scale we've never seen in commercial real estate. This isn't cyclical. Companies aren't going to suddenly need more office space when the economy improves. The transformation is structural. A company that used to lease 100,000 square feet for 500 employees now leases 40,000 square feet for the same workforce. That's 60,000 square feet. It's gone permanently. The demand evaporated and it's not coming back. Every major corporation has done the math. Remote work saves them enormous amounts of money, not just on rent, but on utilities, on maintenance, on all the overhead that comes with physical office space. They've reorganized around hybrid models. They've redesigned workflows. They've invested in technology to support distributed teams. Going back would require them to unmake all those investments, retrain their workforce, and accept lower profit margins. It's not happening. And workers have spoken with their feet, or rather, with their home offices. Survey after survey shows employees will leave jobs that force them back to the office full time. The leverage has shifted. The social contract has changed. The office tower, that symbol of mid-20th century corporate power, is now a relic, and Canadian banks finance these relics at the top of the market. Force number two, the interest rate reality. The era of free money is over. The central banks printed trillions during the pandemic. They drove rates to zero. They created an environment where borrowing was essentially costless. And in that environment, all kinds of bad investments made sense. Office towers generating 4% returns looked attractive when you could borrow at 2%. But now, the Federal Reserve raised rates aggressively to fight inflation. The Bank of Canada followed, and even though there's been some talk of cuts, rates are structurally higher than they were in the 2010s. The days of 0% are gone, which means the entire calculus of commercial real estate financing has changed. Buildings that were marginally profitable at 3% interest rates are underwater at 7% rates. The math is brutal and unforgiving. And when these loans mature, when borrowers have to refinance at the new higher rates, defaults become inevitable. You can't finance a 4% yielding asset with 7% debt. The cash flow doesn't work. The building loses money every single month. Canadian banks are trapped in a portfolio of assets that made sense in a zero-rate world, but are toxic in a normalized rate environment. And they can't go back in time. They can't undo the loans. They're locked in. Force number three, Canadian hubris. This is the psychological element, and it might be the most important. Canadian financial institutions spent decades building a reputation for conservatism, for prudence, for being smarter and more careful than their American counterparts. After the 2008 financial crisis, when American banks collapsed and Canadian banks sailed through relatively unscathed, that reputation hardened into gospel. We started believing our own mythology. We thought we were better. We thought our risk management was superior. We thought we understood American markets better than Americans did. And that hubris, that overconfidence, led to catastrophically bad timing. BMO expanded into Chicago precisely when Chicago's office market was peaking. RBC bought City National in Los Angeles right before the Los Angeles commercial market started its decline. These weren't strategic master strokes. These were poorly timed bets made by executives who believed they couldn't fail. And now they're learning the oldest lesson in finance. Markets don't care about your reputation. Math doesn't care about your self-image. When you overpay for deteriorating assets, you lose money. It doesn't matter if you're American or Canadian, conservative or aggressive. Bad investments produce bad outcomes. The convergence of these three forces creates a scenario that banks simply cannot navigate without pain. They can delay it, they can spread it out over time, they can manage the messaging, but they cannot avoid the fundamental reality: they own billions in loans secured by assets that are worth far less than the loan amounts. Now, here's where the psychology becomes crucial, friends, because the greatest threat to your wealth isn't the crisis itself, it's your response to it. This is what I call normalcy bias, and it's hardwired into human psychology. Human beings are pattern recognition machines. We assume tomorrow will look like yesterday. When your bank account has always been safe, you assume it always will be. When Canadian banks have always been stable, you assume they always will be. When dividends have been paid for decades, you assume they'll be paid forever. This bias served us well in stable environments, but in times of structural change, normalcy bias becomes deadly. It keeps you invested in deteriorating positions because you can't imagine a different reality. It keeps you holding stocks that are slowly bleeding value because selling would mean admitting you were wrong. I've watched this pattern play out across markets, across decades. People hold on to investments far past the point where the thesis has broken, simply because accepting the loss feels impossible. They average down, buying more as prices fall, because surely this solid company will bounce back. Surely this crisis is temporary. Surely normalcy will return. But sometimes normalcy doesn't return. Sometimes the world changes and the old assumptions no longer apply. Right now, millions of Canadians are sitting on bank stocks in their retirement accounts, trusting that these institutions will continue performing as they always have. They're collecting dividends and reinvesting them, compounding their exposure. They're experiencing normalcy bias in real time, and they don't even know it. The companion to normalcy bias is what I call the money illusion. This is the disconnect between nominal wealth and real purchasing power. Your investment account might show the same number of dollars or even more dollars due to dividend reinvestment. But if those dollars buy less, if inflation has eroded their value, if the underlying assets have deteriorated while the accounting has masked it, you're not actually wealthy. You're experiencing an illusion. Canadian bank stocks might maintain their nominal price through accounting maneuvers, through dividend support, through market manipulation, but the real value, the economic value, the productive capacity, that's eroding. You're becoming a millionaire on paper while getting poorer at the grocery store. This is the insidious nature of slow motion financial crises. They don't announce themselves with sirens and panic. They creep up quarter by quarter, provision by provision, until one day you wake up and realize your retirement account has gone nowhere for 5 years, while inflation has cut its purchasing power in half. So what do you do? That's the question I can hear you asking. If Canadian banks are trapped in this crisis, if the provisions are going to keep stacking up, if the dividends are at risk, what is the appropriate response? Let me be very clear. I am not telling you to pull all your money out of Canadian banks tomorrow. That would be panic, and panic is rarely productive. Your deposits are insured. The system is not collapsing overnight. This is not 2008. But what I am telling you is that blindly trusting in the safety of Canadian financial stocks simply because they've always been safe is a mistake. The world has changed. The bank's exposure has changed. The risk profile has fundamentally shifted. Here's the framework I want you to think through. It's what I call the binary choice between paper and reality. Do you own assets or do you own claims on assets? When you own bank stocks, you own claims. You own a piece of paper that says you have partial ownership of an institution. but that institution's value is derived from the loans it made, the assets it holds. And if those underlying assets are deteriorating, if those loans are going bad, your claim is worth less, regardless of what the stock ticker says on any given day. When you own physical assets, real estate you can touch, commodities you can hold, businesses you can operate, you own reality. The value might fluctuate, but the asset exists independent of financial engineering. Gold is the ultimate expression of this principle. And this is where I need to talk about something that will sound extreme to many of you. In times of financial system stress, in times when paper claims become suspect, precious metals become the ultimate store of value. I'm not telling you this because I'm a gold bug or because I have some romantic attachment to shiny metals. I'm telling you this because history has proven it over centuries. When paper claims fail, when financial institutions become unstable, when currency systems come under stress, gold holds value. Not because gold is magical, but because gold is no one else's liability. When you hold physical gold, you don't need a bank to honor its promise. You don't need a government to maintain a peg. You don't need a financial system to function properly. The value is intrinsic to the asset itself. Now, I'm not suggesting you should sell everything and buy gold bars tomorrow. That would be as foolish as doing nothing at all. What I am suggesting is that your portfolio needs to reflect the new reality we're living in. If you're 100% invested in Canadian financial stocks because they've always been safe, you're not diversified. You're exposed to a single sector that is facing structural headwinds, unlike anything we've seen in decades. That's not prudent. That's not conservative. That's complacent. Consider what true diversification means in this environment. It means reducing your exposure to institutions that are trapped in deteriorating loans. It means moving some capital into assets that benefit from financial system stress rather than suffer from it. It means holding some portion of your wealth outside the banking system entirely. Physical gold, silver, assets that can't be inflated away, that can't have provisions taken against them, that don't depend on the health of office towers in Chicago. I know this sounds dramatic. I know it sounds like I'm fear-mongering. But friends, I am reading you the balance sheets. I am showing you the provisions. I am walking you through the math. This is not a conspiracy theory. This is not doom porn. This is sober analysis of publicly available data. BMO's $1.1 billion in provisions, that's in their SEC filings. RBC's capital injections into City National, that's in their quarterly reports. The office vacancy rates in American cities, that's public data from CoStar and other real estate analytics firms. The wall of maturity, that's not speculation, it's the loan maturity schedule. I'm not making this up. I'm showing you what's already happening. And here's the most important thing I can tell you. The window for preparation is closing, not closed, but closing. Right now, you can still sell bank stocks at reasonable prices. You can still move capital without panic. You can still make rational, measured adjustments to your portfolio. But if you wait until the crisis becomes obvious to everyone, until the provisions turn into actual write-downs, until the dividends get cut, then you're selling into panic, then you're exiting at the bottom, then you're realizing losses that could have been avoided. The prepared don't panic because they've already positioned themselves. The unprepared panic because they waited until action was forced upon them. I want to leave you with one final thought, friends. This crisis with Canadian banks and American commercial real estate, it's a microcosm of a larger pattern. It's a pattern we see over and over throughout financial history. Institutions overextend. They chase growth in foreign markets. They lever up balance sheets. They make bets based on the assumption that the recent past will continue forever. And when the world changes, when rates rise, when demand patterns shift, when the music stops, they're left holding assets nobody wants. The specific details change. In the 1980s, it was Latin American debt. In the 1990s, it was Asian currencies. In 2008, it was subprime mortgages. Today, it's commercial real estate, but the pattern is always the same, and the response required from you is always the same. See the pattern before it becomes obvious to everyone else. Adjust before you're forced to. Protect your wealth before the crisis fully unfolds. This is not about being clever or making a killing in the market. This is about survival. This is about preserving what you've worked your entire life to build. Canadian banks will survive this crisis. The system won't collapse, but that doesn't mean you can't be hurt by it. Stock prices can stagnate for years. Dividends can be cut. Opportunity costs can accumulate into massive losses of potential wealth. You have a choice right now. You can maintain normalcy bias, trusting that everything will work out because it always has. You can hold your positions and hope the banks navigate through this without major damage to shareholder value. Or you can acknowledge that the world has changed, that the office tower model is broken, that Canadian banks made poorly timed bets in American markets, that the convergence of forces I've outlined is real and mathematical and already in motion. One approach requires no action, no discomfort, no admission that you might need to change. The other requires you to overcome your psychological biases and make difficult adjustments to long-held positions. History favors the prepared, and the window for preparation is closing. Friends, thank you for being here today. I know this has been heavy. I know I've asked you to question assumptions that feel foundational, but I would rather give you hard truths than comfortable lies. The office tower trap has snapped shut on Canadian banks. The question is whether it snaps shut on your portfolio as well. The choice, as always, is yours.